Well, good evening, everybody. Thanks for joining our founder forum with Morgan Stanley, KKR and Greycroft. Really wanted to start by thanking our partners at KKR, especially Corey Heyer. Put your hand up. Grant Berg. And where's Aaron? Aaron Rockdale. He's the culprit that got this whole thing started. He's one of our go-to alternative specialists at Morgan Stanley. So my name is Kerner Smith. I'm a former founder turned private wealth advisor for other founders, and also a partner of the Altera Wealth Management Group at Morgan Stanley. I'm very lucky to have three leaders in the private markets, venture capital, and tech growth space sitting to my left, starting with Ian Sigalo, co-founder and managing partner at Greycroft, Jay Keller, partner and head of tech growth North America, KKR, and Andrew Daly, managing director and head of East Coast Software at Morgan Stanley. So I'll just start by just saying that being a founder is pretty tough, as many of us know firsthand. One of my clients likes to say it's like jumping off a cliff and figuring out how to build an airplane on the way down. So, today's goal is really just to help you guys get some incremental insights into what's going on the ground in the private market space, whether you're allocating capital or raising capital. So what we're going to do here is we're going to have a 30-minute Q&A session. We'll give you guys the mics for 15 minutes, and then we're going to head upstairs for some pretty kick-ass views on KKR stairs. So with that, let's get started. So I think we have to start.
You didn't screw up the intro. It was perfect.
Okay.
Yeah, it was great.
It was great. Round of applause.
I'll take it back. So I think maybe what we'll do is start in order of when you might want to speak to these guys if you're a founder. So I guess that would be Ian. And so I'll just start with a question. I'm going to hand you guys the baton. You probably don't need me anymore to moderate. But maybe what we could do is the first time you go, just give us like 1 sentence on your mandate in addition to just thoughts on the overall questions. So as far as the venture space, according to Morgan Stanley research, U.S. venture capital has been the best performing asset class in 8 of the last 10 years. Last year took a nosedive, I think down like 50%, that's aggregate. I think it's bounced about 30%. So from a asset class performance perspective, it's done quite well. But if you look at sort of year-over-year deal activity, I think we're still down about 50%, even though we had a sequential bump like fourth quarter to first quarter this year. So starting with Ian, maybe just getting your thoughts, tell us about where you think we are right now, and also just sort of general outlook going forward.
The one sentence Greycroft story, Greycroft invests seed to growth, check sizes, one for the entrepreneurs in the audience, 1 to 50. And like most VCs, we fund loss-making businesses. We're a minority investor. And we look at software, consumer products, and sustainability investing. Those are kind of our three main pillars of the firm. In terms of the venture market right now. So internally, when the partners sit down, we talk about where to go and where to play. I think the cadence, and you talked about how allocations have slowed down in 2023. The reality is that when we call capital, we as GPs and our LPs have to sell shares of Microsoft and Apple and NVIDIA because we're in the public markets for all of our liquid securities. And that's a pretty high bar because every time we invest, we have to sell shares of the best companies that have ever been built. And the second thing to think about is, VCs get paid to sell companies at, try to make 50x, 100x on your money. And in order to make those types of returns, you don't sell companies on an EBITDA multiple. You have to sell and build companies that pose an existential threat to a big public incumbent. So they're willing to pay whatever it takes to buy this business. And with the intersection of that, plus where the public markets are, it's natural you're going to see a slowdown. I think there's a retooling in general as venture kind of hunts for the next new trend. Because we've been investing behind cloud and we've been investing behind smartphone for over a decade. Those two trends are well established. And I personally believe it's AI. Some people believe it's blockchain. Some people are holding their chips thinking it's going to be spatial computing. But we need that next trend to really hit to drive venture returns like you've seen for the last 10 years.
I hate going after Ian. That was good. Yeah. So the quick 2 seconds on KKR Tech Growth. So we are sort of the next rotation of capital. So we are looking at companies that have real products selling into real end markets. We tend to write somewhere between $50 to $250 million checks in each one of our investments. We just announced our latest fund yesterday, which is a $3 billion pool of capital. That's our NGT Fund 3. And we are very disciplined in our technology focus. So we're looking at asset-light businesses in software, internet, and information services broadly. So that's KKR Tech Growth. So the market, we have, again, naturally, we're going to have a slightly different perspective on the kinds of companies that we're investing in and the kinds of opportunities we're looking for, because we're not trying to shoot for a 50x return. We are underwriting to a 3 to 5x return over 3 to 5 years with an intense focus on downside capital protection. We want our capital well preserved, and we're willing to forego some of that, crazy 10 to 20x. But what we can't have is any losses in our portfolio, and that's really how we help manage risk for our LPs and our clients. Our perspective over the last few years is in the, it's representative of this stat that venture has been the best performing class in 8 out of the last 10 years, because the world has been up and to the right. There's a million different metaphors. I tend to use them all, but
and mix them.
And mix them oftentimes. But we sometimes refer to it as the time of great happiness or the great party that we just emerged from. Everything was up and to the right. It was an era of limitless zero-cost capital, and we had the entrance in our space of two groups that we'd really never seen before in the growth equity segment: SPACs and crossovers. And by crossovers, I mean formerly or typically public investors who are then investing in the private markets, and specifically in the growth markets. And they did it in a way that really had never been done before. And these are folks like Tiger, Coatue, Dragoneer, D1, SoftBank, and then to a lesser extent, Insight. What they did was they tried to create an index of high growth private companies. And in our world, the vast majority of the businesses that we're calling the category leading, category defining, category disrupting companies that we are desperately trying to build a relationship with and get into are not for sale. If they are for sale or they're trying to sell, usually we're not that interested. And overnight, the SPACs and the crossover funds turned every private company in the world for sale. There were close to 1,000 deals done in our segment in 2021. Not one vintage, not one cycle, not one fund, but one calendar year, which is remarkable. And in order to do that, in order to make all those companies for sale, you have to value them at irrational prices. And they had raised so much capital that they tended to overcapitalize the balance sheets. That felt like a good thing at the time. There were a lot of high fives amongst entrepreneurs and management teams. There were standing ovations by LPs for venture capital firms and early stage growth funds. And that all works as long as you have a public market that values growth at all costs. And when the times of great happiness and the big party ended in November of 2021, we entered the hangover. And that really was what we saw in 22. The analysts picked up their pencils again. They started to actually look at something beyond top line revenue and recognize this rule of 40 that we've been looking at for decades. Or years, this idea of unit level economics that work, sustainable profitability. And the world fundamentally changed. And what did that do to the market? And sorry to be a little long-winded, but what did that do to the market? All of a sudden you had a huge disconnect between valuation expectations, between the valuations that companies were getting in the public market and the valuations that private companies were seeing. Or expecting. And so that led to this dislocation, this hangover, this time of coming to reality has led to an almost halt in the private markets. And that halt is on two fronts. One is there is some expectation by entrepreneurs and early stage shareholders that the valuation environment is going to come back. Unless memories are a lot shorter than we think they're going to be, that valuation environment isn't coming back anytime soon. But what we're starting to see now is we're starting to see a level of rationalization amongst good growth companies, that it isn't just about capital at high valuations. It's about finding the right partner. And so we're now starting to see an increase in velocity in the market, and we expect that to carry into 24, and we can get into more details about that.
So do you think that's rationalization or capitulation?
I think it's rationalization, because I think one of the things, this idea of overcapitalizing companies at irrational valuations in order to catalyze transactions, and that's ultimately what we saw in 21. What all these companies realized is they now are trapped in cap tables they can't get out of. The shareholders...
Hence capitulation.
Well, in a way, though, trapped in cap tables they can't get out of, so they may be capitulating to reality.
Yeah.
They may be capitulating to a rational world. And the second thing is that many of the companies, in the fear of missing out strategy, many of the companies that get funded in that environment don't really have a reason to exist or a right to win. They were buying customers with venture capital dollars at lifetime value to cost of customer acquisition ratios that are upside down. And so what we're seeing now in rationalization is that many of those companies are going to go away. And they're either going to go away because they're going to go out of business, because there is no more limitless zero cost capital for them to continue to raise and buy customers, or they're going to get consolidated. And we're starting to see that now, and I think we're going to continue to see it to a greater extent in 24.
Time for the positive Morgan Stanley perspective on this.
Before Andrew goes, I had a quick question. Like, when you talk about capitulation, Jake, are you talking about on the issuer side or the investor side? Because I don't know if you guys have seen like those like LinkedIn charts or like that have been floated around online. It shows you who made money by vintage. Oh, here's what the Series A people got. Here's what the Series B people. So are you talking about kind of late stage growth investors wanting a return of capital versus on capital, or is this just issuers taking a lower price than they would otherwise?
Yeah, so I think, to give Ian credit, capitulation was his term. I think that when I said like rationalization, I mean that if these companies want to continue to exist, they do need to raise capital. Many of them need to raise capital, and so in order to do that, I think they're coming to the table and saying, okay, we're not in a world of 30 or 40 times ARR anymore. Instead, we're in a more reasonable, rational world, and we're going to raise capital at a lower price, maybe at our last round's valuation or something lower than that, and bring on a partner that can really help them grow.
Sorry, Andrew.
No, it's all right. I mean, maybe I'll pick up on where you left off, Jake. But Andrew Daly, as Kerner mentioned, I run East Coast Software Investment Banking at Morgan Stanley, and really what we do is help companies like founders like yourselves raise capital, whether that's as a private company from the KKRs of the world after the Greycrofts of the world have invested, or in an IPO. And maybe just to give you some stats on the sort of the challenge that we've seen in the IPO market as interest rates have risen and valuations have, I would say, normalized, maybe not capitulated, or we talk about the great normalization of values back to essentially what is pre-COVID levels in a more normalized interest rate environment. We did 121 technology IPOs in 2021, and just to give you some stats, if you look at a long-term average over the last 10, 20 years, there's typically about 40 tech IPOs in a year. So that's 3 years of volume in 1 year. Now, in 2022, we did 3, and in 2023, I think it's safe to say we'll do less than 5. And so that is a function of challenging times in companies looking at their value expectations on last round and where they might raise in the public markets, because the public markets themselves are very efficient, very sober, very rational, and very picky, because to Ian's point, anytime somebody invests in new issue, they have to sell Microsoft, they have to sell Adobe, Google. They have to sell Google, and to invest in new issue in a company that is largely unproven in a quarterly public market. So where we spend a lot of our time, since we're not taking companies public, is doing exactly what Jake mentioned, which is helping companies think through how do they grow, whether that's as a private company in a consolidated form, with another strategic or with a large-scale capital partner like a KKR who can help them, if they're not Rule of 40, get to Rule of 40, get to Rule of 40 at scale, and then find the next leg of growth either as a public company again or as a part of a broader platform.
Andrew, I know you can't talk about issuers and stuff, obviously, because of privacy and Chinese wall issues, but would you say that, like, behind the scenes, the S1 activity, the stuff that you guys are working on, there's like a huge backlog? Has activity picked up? Have you shifted more towards sell-side M&A? Like, just tell us kind of how things have changed like now versus like 2 years ago.
Yeah, I think there is a willingness and an interest amongst both boards, investors, and management teams to, just in terms of the IPO, create opportunities for companies to go public for a number of reasons. One, companies go public because they sell enterprise software and their customers want them to be public so that they can see their audited financials and feel good about the fact that they're buying software from somebody who's not going to go out of business overnight. Number two, they want to create liquidity and wealth for their employees and their shareholders, which is very important. And number three is, a lot of times it's a big branding event for the company. So creating market awareness for their offering, for the differentiation, typically relative to the large incumbent that they're disrupting when they convince Ian to invest, that's actually coming to fruition. And so there is a real willingness to do that. I would say activity has picked up for sure. There's excitement. I think, seeing companies like Klaviyo go public recently brought a lot of interest back to the table. I don't think that we're necessarily going to see that's not a watershed moment. I think the reality is that public markets are rational. They're very picky, and investors are spending a lot of time understanding and really picking apart every sentence of an S1 to understand what are the unit economics of these businesses? How do they scale? Can they scale profitably? Not at 100, 200, 500 million of revenue, but at $1 billion, $2 billion, $5 billion of revenue. I think that's a really important thing that public investors think about today, because again, oftentimes they're choosing to sell Microsoft, Google, et cetera, to buy a new issue. And so it's a very important consideration. So we are spending a lot of time with companies thinking about 24, 25 IPO windows. That definitely has picked up, but I think to be determined kind of when activity really picks up and hold.
Yeah, I'm definitely eagerly awaiting myself. Morgan Stanley has an analyst in Europe named Edward Stanley that writes a report called Venture Vision. We have it available if you guys want to subscribe. We can add you. But Kathy, our manager, turned me on to that. And one of the things that was an interesting statistic that he wrote was that VCs have raised 10 times more money in a sub 1% interest rate environment than they did in a above 5% interest rate environment, which makes sense. But generally speaking, the IPOs have actually done better in a higher rate environment. So, go figure. I don't know if that's because the economy's doing better, if it has to slow things down and you want to go public in a hot economy.
That's probably because 90% of all venture dollars that have ever been raised have been raised in the last 10 years.
That could be.
Maybe that's the reason.
Probable.
Probable.
Yeah. Small data sample.
Yeah.
I
mean, as a funny anecdote, when we started Greycroft in 2006, I think, and I'm probably directionally accurate but not precise, so like the entire US venture market was deploying like 10 billion, 14 billion a year. Andreessen Horowitz has raised $35 billion in 36 months, like in the past 36 months. A single firm, and they haven't even raised the most. I think there's others that have raised more. And there was a point, probably like maybe it was like in 16, 15, one of the large private wealth firms, not Morgan Stanley, came to our office and they had money from China. And they said, we're trying to deploy, they had $1 trillion wealth management division out of China. Our target allocation is 1% to 2% into US venture. I said, you know how distortionary 10 to $20 billion of LP commitments from a single wealth management group would be to the entire market, but they had a target allocation. And that's how we ended up in one of the bigger booms in the history, if not the biggest in the history of venture. And you know this too, returns follow capital inflow into a space. So when you have massive capital inflow, you have massive returns.
Yeah. We're still in pretty good territory a 10-year window. So it's
Yeah.
So Jake, you're a Navy guy, which I want to hear some stuff upstairs.
Sweet.
But we were talking on our call yesterday just about how a lot of founders don't really understand truly what's going on the ground, and that there's kind of this tide that's being washed out, right? I mean, we bounced off the bottom, but we're still down like 50% year over year. So, and I know I forget if it was Ian or Jake, you shared some wild story about like health tech and stuff. But what do you think the biggest sort of misunderstanding or lack of appreciation is in terms of entrepreneurs out there for what you guys see day to day?
Biggest misunderstanding. I mean, I wouldn't be so, I wouldn't be arrogant or bold as to say that there's a huge misunderstanding amongst founders. I think one of the just natural truisms of what we've experienced over the last 10 years is that the vast majority of entrepreneurs and the vast majority of even venture and early stage investors have spent their entire professional career in the longest bull run in the history of the modern U.S. economy. And so what that means is it doesn't make anyone a good or a bad person, or it doesn't mean they've got a misunderstanding. It means it's just a lack of perspective in terms of what happens in these cycles. What can you expect, or what do you have to be aware of and be conscious of? And I think that has implications and ramifications for everything you do from an operational standpoint throughout in your day-to-day running of a business. And I think it's where good partners come in for the opportunity for an entrepreneur, not necessarily to take take capital at the very highest value, but recognize how important it is to bring people in with different perspectives and different experience sets. People who can help you see around corners, who have been there before, who have made mistakes before, and are humble enough to tell you about all the mistakes that they've made. I think that as much as anything crystallizes what we've seen. And then my joke is that YPO is a cult and the best places to work lists are a farce. But we just lived through, and I say that just because in YPOs you get people who commiserate, who don't necessarily have that experience, that chronological experience of what it's like to go through these different things. And the best places to work lists have been funny, right? In the last 10 years, everyone wants to be on those lists. There were labor wars of trying particularly to get engineers and developers. We would tour early stage $10 million revenue companies that had $30,000 espresso machines and bourbon libraries. It's like, yeah, I get it. This place is awesome to work and nobody ever gets fired, but that is not a reality.
So when KKR invests, do you insist that they get rid of the bourbon library
No.
and the $30,000 espresso machine?
No, it's a great point. We're about to take you up to the 80th floor to have cocktails on our terrace. So maybe that's going to come back to haunt me.
I walked into your office and you had KKR chiseled into stone downstairs.
Hey, our analysts work hard. All right?
Got it.
In case you haven't noticed, Ian and I have known each other for a long time.
I have one question in here for you. How long does it take you to diligence a company?
So,
and what did that look like? I think the entrepreneurs are really curious, but what did that look like 24 months ago? What does it look like today?
And that's a great question, and it's one that we got a lot, especially during our fundraise. And I'm going to put it back on you too, in terms of.
Go ahead.
My sense is you guys just write checks.
Yeah,
but,
every day.
But yeah, exactly. But what true story in growth equity, I think the truism over time has been, the time between first call to close transaction is between 2.5 to 3 years. And our entire strategy and what we talk about is creating a proactive origination engine where we ask really, really talented young people to call and start relationships with companies so that we can get to know them over a period of time. When we get engaged with a company, we typically say that it will be a 6-week period for us to due diligence. And that's because we know the company very well before we even sign on the dotted line, and it's because we've done a lot of work leading up to that. What happened in 21 and sort of the back half of 20 is there were crossover funds and there were venture capital firms emerging into growth that were writing checks same day. It was not atypical. I mean, this happened almost on a weekly basis, that we would get a call from investment bankers that said, hey, that hot company that you're chasing has 2 term sheets. They're going to close a deal on Friday. Do you want to participate? And we got the question all the time, how are you going to compete with that? And we said, we won't. We are very disciplined in our diligence and consistent with our deployment. And that has, at the time, it seemed contrarian, as certain firms were doing a deal and a half a day, an average a deal and a half a day. And we're upfront and we're honest about that. And we say the reason why we do so much work is because we want to know your company well. We want to add value at the board. If you don't want that, we're fine to walk away. And we did. We walked away from a lot of deals because we do our diligence. We spend a lot of time. We've got extraordinary young people who work very hard, not necessarily chiseling KKR into granite, but really understanding what companies do and how they do it.
Could we do like a rapid round of just the metrics that you look at? Like I'm sure yours are probably wider, but like
Very wide.
He looks at the color of the website and he's like,
Blue.
I got it. Yeah.
All in.
But obviously with Ian, that's going to be wider. It might be more qualitative and quantitative. But for you, writing $50 to $200 million checks, and then Andrew, like, what's sort of the bar for us to work on? So maybe in any order. Just curious, so people can hear kind of.
Yeah, I mean, maybe in the latest stage of software, we try to. I mean, it used to be you needed to go public. You needed around $100 million of recurring revenue to kind of think about accessing the public market. Now, our lead time to get to know a company is also typically 2 years, so we like to get involved early. So north of 50 million in revenue is really when we start to dig in with companies, help them think about their equity positioning story. In terms of like M&A outcomes, Morgan Stanley would tell you like the sweet spot is plus or minus $1 billion of transaction value. So it's definitely on the later stage side. Now, particularly in this latest wave of AI, there are companies with less than that in terms of revenue, less than that in terms of scale that are achieving far bigger outcomes. And I think that speaks to what Ian said around kind of the next big transformational wave in technology. So it kind of depends, Kerner, but in like pure enterprise software, $100 million in revenue, growing 30%.
Profitable.
Approaching profitability.
Profitable.
What's the growth percentage in terms of it being a VC story versus a PE story? You think, or do you think
it takes all manner of forms, to be honest with you. Yeah. Some lower growth, more profitable. Some higher growth, less profitable. But what we really look for is companies disrupting a large market opportunity with a clear competitive moat, a really strong management team, and fundamental unit economics that are powerful, regardless of whether or not the company's profitable today or not.
I agree.
So we're, again, writing $50 to $250 million checks, and we start to really talk to and engage with companies as they see 10 million of ARR somewhere. Again, to keep the metaphor going, it could be just on the horizon, but they're speeding towards it. It could be that they're just passing it, or it could be way in the rearview mirror. But 10 million is where we start to get interested, and where we're typically investing is when a company has around 15 to 20 million of annual recurring revenue in some form or fashion. What that tells us is it tells us about the risk we don't take, that we don't take product risk, we don't take market risk, we take execution risk. And so that tends to be the bogey for us. I think there's less science or less art or science in it. It's just, that tells us a lot about a company. But from there, it's everything below that top line that starts to get us excited. As Andy was talking about, it's unit level economics that are working. Whether or not there is actual profitability that day or at that time when we're investing, there is at least a path to profitability. There's a path to self-sustainability in the company. And then we look at things that are outside the P&L. We really look at customer engagement. We look at how cohorts are behaving, how clients or customers of these companies are talking about and using the software, the service, or the solution. And so that's tends to be how we think about it. And then lastly, we're hyper-focused on management teams. We are not operators, and we admit that on the way in. We're not there to mandate strategy or change day-to-day operations. We're trying to back existing teams that are world-class.
I think the venture business is similar to the growth business with a couple notable differences. First off, we have no minimum revenue. So we'll do things that are an idea, but we do care about teams and the strategy and the space and the market. Second thing is we can't be in businesses that are growing slowly. Our cost of capital is high. We have to be in companies that are compounding at 100% a year. And the risk we take is, will it compound at 100% for 10 years, 5 years, or just next year? And if you grow a business that doubles every year for 10 years, you can do the math, it's 100x bigger than the day you invested. So if we find a great company that's going from 5 to 10, and you're right that like this 5 to 10 turns into 2040, it'll be $500 million of revenue in 10 years, and then we take it public. But those are hard to find, and you need the right team and the right strategy and the right product. And I think the last thing is, because of the way the venture model works, we try to find businesses where if you own 10 or 20% of the business, because we generally, if we're good, we own 10 to 20% at exit, you can return your fund. So our funds are about $500 million. You can do the math. You need to get a $5 billion public company out the other side. So it has to be in a big enough market that it can sustain that type of outcome. And when you have kind of those blinders on, that kind of forms the set of opportunities we spend time on.
And then how do you think about, from portfolio strategy, how do you think about your hit rate? Like, how many companies would be in a portfolio?
Yeah.
And how many of those are going to return the fund? How many are you planning won't return capital at all?
So historically, about a third of the companies don't work, and you get back less than paid in capital. About a third of them do something. You get somewhere. Probably the average of that middle third is a 2 to 3x, and then a third of them work. And the big mistake VCs make is you sell the ones that are working too early. And that's the hard thing, because the buyers want to buy the third that are working from 1 year in, because they see it going 5 to 10, like, oh, we'll pay 100, we'll pay 200. And it's talking the entrepreneur's like, no, just wait, because that's going to be $5 billion if you keep waiting. And at some point it can become irresistible, and then you end up with a fund where your number one company, instead of returning 100x, only returns 10 or 20x, and that's really tricky. But that's kind of portfolio construction. You don't want to be a venture index, because the index stinks in venture capital. So you need to have tighter selection criteria. And I think 30 or 40 companies in a $500 million fund is a good number if you're trying to pick over the course of 3 to 4 years, because you end up with, like most firms have 5 or 6 partners, they're doing 1 to 2 deals a year, and it kind of flows through.
Jake, what kind of exits are you underwriting? Is it you invest in a company, it has to be IPOable? You invest in companies where you feel like there's a large strategic bid down the road? Like, how do you think about the exit underwriting?
So it's a great question. We talk about it as like the holy trinity of exit options. And what I mean by that is we don't underwrite to a single exit option. And that, by the way, was the problem with that, irrational valuations and overcapitalization. They were underwriting to, again, as I said, an IPO into a public market that values growth at all costs. We don't do that. We almost never underwrite to an IPO exit. What we try to do is underwrite a business that, again, we believe where the unit level economics will work. That means that they will have high gross margins, they'll generate profitability over time, such that they will be an attractive acquisition target for a late stage private equity firm. Secondly, we're trying to invest in these category-leading, category-defining companies that someday, as Ian talked about, will be viewed as invaluable to a large strategic business. And if you can get those two groups interested, at least historically, you would have the large strategics competing on price and value, and you would have the private equity firms competing on speed and speed to close. And that creates a tension where you generate really good value. And such
a good question. Can I just tee it up just quickly?
Yeah.
So, sorry, but this firm has a late stage buyout firm.
Yeah.
So how does that work internally?
So do
you pre-run this thing? Like,
no.
We're doing this deal. This will be really good in 5 years.
We specifically don't do that.
Okay.
And that would be the death knell of our growth strategy. If all the companies that we're investing in felt like the inevitable end game was that we were just going to trade it to our late stage fund, it would be game over. There would be very few partners that we would find. So we explicitly don't do that. But just to finish out, not all of our companies are going to be IPO candidates. But if for that select group that have some of the characteristics that Andy was talking about, if they reach that size and scale, if they've got a good, predictable story for future growth, they can hold out with that option. They can hold out the strategics, they can hold out the private equity firms with the notion that they want to go public, and it's at that point that you get someone to do something irrational. And if they don't, then you IPO.
So we're just past 30 minutes, so I want to hand it over to the audience, but real quick, any like sort of last words of wisdom on private markets or just like advice for founders? You don't have to answer, but if you want. Maybe Andy, if you want to start.
I mean, focus on your core product, your differentiation, and define your market and just attack it. I mean, I think first principles is, we always, like, when we're talking to a company about going public, when to go public, when to not go public, it always comes down to first principles, what's best for your business. These capital raising events are just one moment along a long arc of a company's evolution and value creation for employees and management teams, and I think that's the most important thing to keep in mind, whether it's the earliest stage or late stage M&A exit.
That's very well said. And I would just say, not all money is green, but not all capital partners are equal. And as you're thinking about, again, on this capital journey, understanding what the priorities are at each stage, understanding what it is that you're trying to accomplish at that stage. If it is value maximization, then the value is going to be really important. If it's about the next phase and the next stage of growth, I think the partner that you pick is critical to that.
I have nothing to add. That's great. Let's get some questions.
I don't know if Ian's sharing what he really thinks tonight. Maybe we'll get him a couple of tequilas.
Highly censored on video.
Yeah.
Okay. Well, does anybody know what the mics are back there? There's a couple, I think. Anybody want to start with a question? You have
Go ahead.
Yeah,
We'll repeat the question.
Yeah, we can hear you.
Go
We'll repeat
ahead.
Thanks. Rob Colorina, AIC Family Office. How important is it, in your perspective, of who's in the deal at the time you guys are taking? The question is, how important is it as far as who is in the cap stack when you're taking a really hard look at the business, and some thoughts around that?
For venture, it's generally less important unless it's somebody bad. It can be a negative signal. But we'll do stuff that has nobody in the cap structure at all. So that's the base case for a lot of the seed activity. There are times when there's somebody bad in the cap structure, and I think bad venture folks can kill a company, so we try to avoid that situation. But on the upside, there's some signal with certain firms in certain categories, but it's so partner dependent. If you find the right partner in the right space who has a good point of view, partnering with that person, first off, it's more fun, and second, it does have a little bit of positive signal, but it's not something that we underwrite to.
For us, it's critically important, and we spend a lot of time. I mean, it's if you ask any of the people on our team when they bring up an interesting company, one of the first questions we ask is who's in it, who's invested so far. I mean, we love to find bootstrap businesses that haven't taken on institutional capital before. Those are almost obsolete at this point. But the reason why it's so important, and it's what we talk about, is violent alignment with shareholders and management. And so we spend a lot of time from a relationship standpoint with those shareholders, making sure, because by nature, if we're coming in after them, we have a different time horizon, and making sure that we're, again, violently aligned on how we're going to create value for the business and what end game is. And the best part about this business is building relationships over time with investors in the category, and one of the best parts, investors in the category that you can establish a relationship, what we call like and trust here at KKR, where you can do deals over and over and over again, and build a rapport in sort of a battle rhythm with certain investors, so you know what you're getting into, and you look forward to the good stuff and the tough times.
It's important for us, but a lot of times we're helping companies figure out their capital stack and bring new partners in. So I would reiterate what Jake said. I mean, money is fungible, and the partner that you pick is really important, because particularly for management teams, a lot of times these partners are going to be on your board, and those board members are going to be your chief supporters in times that are really tough, ask you, challenge you with critical questions, and ultimately help the company grow. And so it is very important. And it only gets more important as you think about entering the public markets, where your capital stack will then be a lot more fluid because it's publicly traded.
Anybody else? Brianna?
Thanks, guys. This is really interesting. My name is Brianna Shaw. I work with Andrew in tech investment banking, work closely with him. So what I'm wondering is, so we have these events that happen in like 2019, 2020, right, that then create 2021, that then create 2022, and the hangover that comes after 21 and 2020. What is the current economic climate going to create in the future? So, and obviously none of you have a crystal ball, but what's the macro right now, and what's the impact going to be in the next 3 to 5 years?
Go ahead, Jake.
Yeah, thanks a lot.
Take this one.
Great.
I'll start. I think the businesses that are funded in this market will be a great vintage for returns because cost of capital is high, investors are more selective, and the businesses that are funded are ultimately stronger, healthier, better managed. And so, I mean, as capital is constrained, cost of capital increases, like returns flow, like investment flow to the highest return opportunities.
I like that answer.
Yeah, and then we obviously we're coming off of, well, not obviously, but I mentioned we're coming off of a fundraise right now, and we feel like there has been no better time to go find really interesting companies and invest in them. I do think it's going to be partially dependent on how short or how long people's memories are, and that's people in sort of at every level of the industry. It's going to be about how short or long LP memories are. It's going to be about how short or long, venture capital and growth equity investors are, because at the end of the day, the buyout world at that end, the math hasn't really changed that much for them. And I speak a little bit pejoratively, but I think if some of my partners were here, they would say the same thing. And so a lot of it, I think, is going to be contingent upon sentiment, and then we're going to have interest rates, right? Again, we were in such a long period of time of zero, in a zero interest rate environment. We are now at, historically, at least in most of our lifetimes, a pretty high interest rate environment. And that is going to impact, I think, the returns that we'll see. But there's no question that, I think this is a really, really good time to be investing and to be finding great companies.
I think there's a lot of things that can happen. But I think 10 years from now, if you think back, like, man, it was 10 years ago, I was at KKR's office, and Jake and Ian were talking on the panel, and we didn't. Oh, and Andy, and we weren't. And Andy, you work with Andy, so you probably talk to him every day. But we weren't thinking about the fact that AI was coming into the world, and it was changing absolutely everything. And Apple was weeks away from launching the spatial compute platform, and Tesla's launching robots, and like one of those things is going to hit in a way that's going to remake the global economy. And that's what really drives my business. It drives your business too. It drives everybody that's investing in high growth technology stuff. And by remake the global economy, there's $100 trillion of global GDP. There's 8 billion smartphones out there. We've seen what happens when you give 8 billion people access to a supercomputer in their pocket, always on and connected to the internet, and how that changes media, and how it changes entertainment, and how it changes, everything, all your productivity applications. Will AI do the same, and will there be $5 trillion of revenue created in the AI space, and then how do you play that? And I think so. And so that kind of dwarfs, whether the Fed raises rates by 25 or 50 basis points when you're looking, 10 years on the horizon.
You guys have like one or two more?
Hi there. My name's Ben. I'm a climate tech sustainability founder. And I'm curious, from the founder perspective, it has seemed that the investment world is still not really sure what climate change or climate risk means for them, how to use it. And I'm curious your views on you talked about AI and some of these other trends, but there's the big old black box that is threatening a whole bunch of major verticals. And I'm curious, is climate a vertical? Is it the thing that stretches over everything? How do you think about it?
So Greycroft's view is, could we have a sustainability fund, a sustainability product? And we map underlying technologies to each of these fund products. So I spend all of my time in software, which is why you're getting the whole AI spiel. For me, if you talk to my partners who run sustainability, you're going to hear a totally different line about microbes that eat plastic out of the ocean, and energy efficient supply chain, and water, and what's going to happen when drought overtakes a huge portion of the United States. How are people going to access to clean water? And that, I think, is the other major inevitability of like what will happen and where investment returns will be generated, because the entire industrial economy is going to have to re-industrialize for the first time in 100 years and remake the global economy in a way that doesn't consume all of our natural resources and we can still live on this planet. So it is a mega trend. It is, it's questionable about kind of early investment returns right now, unlike, say, software, which is proven in the public market. There aren't a lot of sustainability IPOs. There are companies that have a flavor of that, but there's a lot of product coming. And I think it's a great place to invest and a great place to build if you're looking at it from a 10-year horizon. We did ours with Coca-Cola, our fund product, and their bottlers, because we needed expertise outside of our four walls to understand like how applicable is this technology today, and really how big can it be. But if you're producing all of the product they're producing, they look at this like, well, if you could replace plastic, what's that worth to us? I mean, many, many tens of billions of dollars.
One more.
Hi, good evening. I'm Nidhi Sharma. I'm with BlackRock's private capital investing team. Historically speaking, during periods of market stress, it's a great vintage for private equity, generally. But one could argue right now that the rationalization in public markets means, along with the mega-sized funds that you have, this would be a great opportunity for buyouts. The lack of IPOs would create opportunity for growth in private debt, and the declines and discounts that you've seen in venture would make it attractive as well. So I'm curious if you think that the opportunity set is equally attractive across venture, growth, private debt, and buyouts.
I mean, I can speak for growth. I mean, I do think. I think it is I think it's an equally attractive environment for certain participants in each one of those segments. I think for the well-capitalized funds, whether in venture, the firms that have performed and behaved well over the last few years. I think for the growth equity firms that have resources to provide, the best entrepreneurs in the world, and I think buyout firms who have been doing this for a long time and have a lot of sophistication around the kinds of companies that they're investing in. I think it's going to be a very good opportunity across the spectrum. But for the simple reason that, again, valuations have come down. There are people who are taking a pause. We don't see the extraordinary velocity that we saw, in 20 and 21. I think there's a more selective opportunity to invest in interesting companies in each one of those categories. The question is for how long that lasts.
Yeah, I think the alts market follows what you're seeing in the public market, but it's going to take longer for this valuation phenomenon and underwriting improvement to flow through. And companies raised a ton of money. So I don't know. I think the vintage in 23 will obviously be better than the vintage in 21 and 22. 21 is going to be a terrible vintage. But 24, in my view, looks better than 23, and 25 looks better than 20. Like, just looking out, because this interest rate movement will take a lot of time to flow through the full waterfall.
Should we squeeze in one more?
Connor, you're going to ask a question?
This will be the last question.
I work with this guy, so you can't ask me a question.
Yeah, unfortunately, not for Ian. My name's Connor. I sat next to Ian all day today, so I'm not going to ask him a question. This is for Jake and Andy. I work more on the growth side of the business, and some of the best companies we look at, like you mentioned, are like really overcapitalized. Yep. So if you're in them, Andy, as a board member, what advice are you giving them, especially in an environment where investors don't like burn? And then Andy, as you're writing these S1s, kind of same question. What do you advise them to do if they have, like, you talk to them, they raise a ton of money, they cut costs, and they're like, oh, we have 10 years of burn. It's like, what do you do with that?
Yeah, so I'll go first. I think, again, there had been the same conversation happening in Q4 and Q1 board meetings for 5 years leading up to last year. And I say Q4 and Q1 because what happens in those board meetings is boards will get their first look at the following year's budget. They'll comment, they'll provide edits, and then in Q1 at the Q1 board meeting, you'll approve the budget for that year. And for the 5 years leading up to November of 22, the conversation was you're sandbagging, spend more, grow faster. And the management teams would go back, they'd adjust their numbers, and in January or February, you'd approve the budget and you'd be off and ready to go. At the end of last year, the conversations changed dramatically. They were using terms that hadn't been used in a while, which is cash runway, cash out, cash burn. What is your runway with the capital that you have? And you have to think about conserving to last as long as you can. And so nearly every one of our businesses, that was exactly the conversation that we were having, which is how do we conserve, how do we cut back? And by the way, we saw the ramification of that this year in 23. I've been calling it the revenge of procurement. Procurement got their red pens back. And there were small companies that would have 35 different tools, literally that would buy anything that would help sales and marketing. And when people started to rationalize where they were spending money, it had implications across the B2B software industry. And so for us, we've never been, with few exceptions, we've never been growth at all costs investors. We've never expected unnatural, superhuman things to happen for our companies to get returns. So what we continue to focus on is rational growth, thoughtful, strategic growth going forward. And I think, that's becoming more of the norm in the companies that we advise.
Yeah, I mean, I would completely agree with that. I think that's the big thing is the reason that I think people are focused on the cash runway and the burn is, in one part, the valuation environment has changed, but in the second part, the demand environment for a lot of these IT products has also changed. Sales cycles have elongated. If you think about top of funnel marketing to closing a deal, you need a bigger top of market funnel for most companies to get to $1 of sort of revenue at the end of the day. And so thinking about the efficiency of your marketing spend, when we're taking a company public, we're typically not telling them how to manage their business. We're helping them articulate how they manage their business. And so what we look for is metrics, storytelling around cohorts, sales performance, the way customers spend over time, and really helping highlight what's valuable about a business model, what's compelling about a competitive moat from a technology perspective, and tying those two things together to really tell a powerful story of an investable company.
Well, I think we got to wrap it there, but let's give these guys a hand.